Good afternoon, everyone, and welcome to Prestige Wealth Management Group's third quarter 2022 economic and financial markets update. On this afternoon's webcast, you're going to hear from Prestige Wealth Management Group's CEO, Roy Williams, Prestige Wealth Management Group's Senior Portfolio Manager, Paul Esposito, and Wealth Advisor, John D'Angelo. Some quick housekeeping. This webcast this afternoon is being recorded, so you will receive a copy of it after it concludes. We will not be able to take any live questions on the webcast today, but if you have any questions, please send them in to pwm@prestigewmg.com, and we'll be sure to answer them for you. And with that, I'm going to pass it over to Paul Esposito.
Michael, thank you very much. The close of the quarter, certainly, again, delivering a very difficult environment, much like Q2. U.S. Federal Reserve and inflation were front and center. The Fed's response to the rampant inflation that we've experienced over the course of the last year and a half has been, the key element of risk in the markets. And the Fed's efforts in bringing that inflation number under control have been most prominent. Ever since Jackson Hole with Fed Chair Powell's remarks coming to balancing out their objective of price stability as well as full employment, and even possibly willing to sacrifice full employment, in at least what some of his commentary alluded to, is really what has been rattling markets a lot. A major question that investors have had this year, given the economic environment, the downturn in the equity and fixed income markets, are we, or have the markets already priced in a recession? Are we in the process of one? And there have been, some conflicting opinions about that. If we look at GDP metrics, Q1 and Q2, we had two negative prints. We were down 1.6% on an annualized basis for Q1. Q2, we were down 0.6%. And if you look at the rule of thumb for recessions, that would coincide with a reading. However, that's not the official reading. The National Bureau of Economic Research actually has 6 metrics that it uses to figure out whether or not the economy is in a recession. And just a note of caution, anytime the NBER data is released and they provide their recessionary reading, it's usually done 6 months after the U.S. economy goes into an official recession. So many of the inputs are lagging. But if you look at this year, there have been a lot of negatives to some of the data that they track from just within the last few months. In particular, when you look at industrial production starting to flash yellow, consumer spending on an inflation-adjusted basis, the same thing with retail sales, showing a distressed consumer because of the higher than expected inflation run. The same thing with incomes. Now, incomes have risen on a year-over-year basis, but when you adjust them for inflation on a real basis, you're starting to see those cost of living adjustments eroded by inflation. So really the only bastion of hope for this panel of metrics has really been in employment, both in non-farm payroll data and household survey employment, which at some point is probably going to be really the last straw, especially when you start to hear a lot of the layoffs being announced. Most notably today, Meta or Facebook, whichever you prefer to identify them as, made mention of an 11,000 count layoff. You also had some other tech companies, Twitter, IBM, Microsoft, make similar mentions of shrinking the labor force. And at some point, that's going to trickle into these numbers, and we very well could see an official recessionary reading either later this year or into next year would be the expectation. But keep in mind that data is lagging, okay? Most of the GDP data is lagging, especially when we look at, what transpired in Q3 for GDP. It was a positive print. We had a 2.6% print, but when you look at the components of GDP, it was really due to an adjustment of net exports and a lack of imports. And that was approximately, that accounted for, almost all of the GDP gain. One of the areas that sort of got muted by that was in residential investment, mostly due to housing and rising interest rates was down 26%. So if you actually took out the outsized contribution of exports, we probably would have seen a 0.2% decline in the GDP numbers. But getting to the labor picture, this is JOLTS data, job openings and labor turnover survey. Chart to the left is showing the number of open jobs to every unemployed individual. So we were at 2 to 1, and I think there's something like 10 million open jobs at the peak. So we're still close to that, but we are starting to see some cracks. One would probably be in the fact that a lot of job openings are starting to be shuttered. And you would expect that with corporations concerned about keeping margins in check and demand starting to come into question. Naturally, corporations will start retracting a lot of the jobs that they had planned for annualized growth. Quits, that's, one of the trends that we saw post-pandemic was obviously the Great Resignation and the more recent trend of quiet quitting. You saw a big spike in the job seekers' ability to find new work, and we're actually starting to see that come down. So I think that is portending to some weakening in the labor market. Layoffs have still been at a low, and that's evidenced by the very low unemployment rate, but we should expect to see that tick up. Again, it's a lagging metric. The unemployment rate is still ratcheted down to 3.7%. Wage growth, on the other hand, has been, fairly high, but again, adjusting that on an inflation-adjusted basis is actually showing a weakening number. So it would not surprise us to see the unemployment rate in the quarters ahead start to uptick. And if the NBER data does at some point point out that we're in a recession, we would not be surprised to actually see an uptick in the unemployment rate start to coincide. But with that, let's discuss inflation a little bit more in detail, because this has certainly been the battle that the Fed and the markets have had for this year and will continue to have. And with that, Roy, I'd like you to comment a little further on inflation.
Yeah, when we look at inflation, it's been significant, and we all have really felt it. It is not transitory. As the Fed once said, it's real, it's in the stores. I was at Costco last night, and you can see it in the meat prices, the fish prices, and canned goods. It's all throughout. And when you go to the store and spend $90 and walk out with less than one bag of groceries, you shake your head. So we're all feeling it. And it's a situation where when we look at inflation and the comparisons of year over year, remember we're coming from a place where gas prices were significantly lower in 2021 and, beginning of 21, and to where we were now. I mean, we peaked this summer at $5 a gallon for gasoline. And you think about gasoline, that impacts transportation, that impacts, everything that we do. We fly, we drive our car. It's a significant impact. So the inflation numbers that have been in the past 12 months, the expectations have been significant, but the expectations as we go forward, when we look at the forecasting, the forecast for inflation is that numbers are going to start coming down, as we've seen, and John's going to talk about, the price of oil, wheat, corn, lumber. Just use lumber. Lumber at one point was over $1,400, now it's at $450. As of today, 450 something. So you have seen some drops in inflation. And year over year, the challenge has been when it's, some of it's lagging when you're looking at housing. So when you look back 12 months, you were still having bidding wars on housing. Rents, clients who rent or they're looking to rent a place for the winter in Florida or North Carolina or South Carolina, prices have significantly increased, and that has continued to be a thorn in the side of, getting inflation under control. But as we've seen, expectations, hopefully, as we move into 2023, that inflation will come under control and will come back down and be normalized. While the Fed wants 2 to 3%. So as we look at the expectations, the next 5 years, they are expected, because remember, it's a year-over-year comparison. So the comparisons get easier as we go forward, year over year, as the numbers, were higher at the beginning of this year. So in the beginning of 23, it'll be an easier comparison. But as you see, the makeup of inflation, shelter and, food costs and new and used vehicles, I don't know if you follow Carvana. Carvana is now trading at $2 a share. And a lot of these used car places have excess inventory, and they're paying top dollar for these cars. And now dealers, I spoke to a client today, in order to get a pickup truck, they paid $6,000 over invoice, for a pickup truck. And they had no choice. And hopefully, as we go through that will, as inventories, continue to increase, that will improve. And again, inflation, as we look at the projections going forward 5 years, they're looking at 2 to 3%, which is a normalized number. With that, I'm going to have John talk about commodity prices.
Thanks, Roy. So this, I guess, you could look at as a glass half full or glass half empty exercise. Are commodity prices telling us that we are coming out of a highly inflationary period, or are they leading us into a recessionary period? Perhaps both. But one of the things that this chart, shows, and it's pretty explicit, is that since the Fed really kind of moved into what we would call highly aggressive rate hike mode, we've seen commodity prices crumble. They've fallen in an extraordinary fashion. We'll have to see, I guess, from a WTI or from an oil perspective, if we get some more follow through, just because recently we had OPEC, or I guess Saudi Arabia, you could say, part of OPEC Plus, cut some production. We've also released a lot of strategic reserves here in the United States. At some point in time, the U.S. is going to have to replenish some of those reserves. So does that mean that oil prices tighten up a little bit from here? Perhaps. We'll have to see. But it is I think from an inflationary standpoint, a positive leading indicator that we may have peaked, and at the very least, maybe we're plateauing, and we'll have to see. In a couple of days, we're going to get another report and see if we are indeed easing a bit. We can also look at the impact that the Federal Reserve has had on housing. If you think about the amount, not only just the amount, the pace and the speed that the Federal Reserve has raised interest rates this year, has had a massive impact on home sales. Maybe we haven't seen that impact yet as much in prices, prices might be a bit lagging. Maybe we see prices start to fall on the back end of this. But, we've seen the Federal Reserve take interest rates up from, barely zero to, a federal funds rate that we're expecting to see potentially by the end of the year, close to or possibly 5%. And that impact, if you look at this chart, it had an incredible impact on mortgage rates. So why are home sales falling at the fastest pace in 25 years? I mean, it's pretty simple to look at. We went from mortgage rates that not too long ago were, between 3 and 3.5%, to now north of 7%. And that's happened in an extremely quick fashion. We're talking about maybe a 6-month period, and that's had a major league impact on on borrowing costs when it comes to affordability for a home. So we've seen demand kind of dry up, and now I think the next step may be that we'll start to see homeowners start to be forced to cut prices of their homes in order to sell them. We'll see what the new home market looks like once we get into a buyer season again, which should be in the spring. So we could talk a little bit also, Roy touched on this not long ago when we look at durable goods and we talk about, used automobiles. At some point, when we looked at what we would consider these supply chain problems or these supply chain issues, they caused what I would consider a massive mispricing in the automobile industry. In the early summer, some cases, you could sell a used car that was a couple of years old for the same price as a new car. And to Roy's point, people are going out and paying above MSRP for new vehicles. It's unheard of. I mean, it's things that if you go back and you think 10 or 20 years ago, like if you would have told somebody they'd pay above MSRP for an automobile one day, they'd look at you with crazy eyes. As we are seeing supply chains come back online, and we're also starting to see, a rise again in inventory, we're starting to see this normalize a bit. We're starting to see used car prices come back down. Now, look, they're still, I think, inflated, but they've been coming down a bit. Maybe perhaps, paying above MSRP for a new car in the near future will go away, as these supply chains come back online, and that's going to happen with inventory. So we talk about consumer goods and we talk about inventories. This chart, this may be the most telling chart from the standpoint of inflation and maybe seeing inflation ease is the rise in inventories. If you get this substantial rise in inventories, you're going to have to see some of these companies, some of these retailers are going to have to start discounting prices, maybe put things on sale in order to start, moving inventory. Maybe that'll also add to, a bit of an easing as we go through the next couple of months. We look at, CPI numbers. I mean, like I said, this, from a glass half empty perspective, maybe this is also a little bit leading toward, maybe when we do look at, some of the recessionary numbers as we go in the next few months, we'll find out we were or maybe are already in one, and we just don't have the print yet. But with that said, let's talk a little bit, Paul, maybe about equity valuations and in relation to some of the things that we've already talked about today.
Certainly, John. So with the quarter, we've already gotten well over 85% of the S&P 500's earnings in for Q3 already reported. And, many securities analysts and economists were calling for, a shrink in growth for Q3. Again, in a very similar format to Q2, it was a mixed bag of earnings, with the exception of what guidance for Q4 was looking like, because there's certainly been, of the all the S&P 500 companies that reported, there was a good number, I want to say well over 50, that were projecting negative guidance into Q4. But when we look at the blended earnings of the S&P, they still manage to increase on a year-over-year basis. If we look at Q3's annualized increase in earnings growth was about 2.2%. If we compare that to Q3 of 2020, which was a minus 5.7% growth, that still, looks fairly healthy, but it was very spotty. Most of the earnings came really due to the energy sector, the rise that we saw toward the end of the quarter in natural gas and oil prices, with obviously all the geopolitical concerns and strategic petroleum reserve refill concerns coming into the next quarter. And then maybe a handful of other companies, consumer staple companies and defensive companies reporting their earnings. So if we were to actually strip out energy and again strip out some of the other defensive company earnings, we probably would be in a negative earnings growth environment, which would at least again portend to some sort of a troughing in earnings, or at least the prelude to a troughing in earnings. That being said, as we close the quarter, even looking at those forward earnings projections, we were trading at 15 times earnings on the S&P, which, going back to the pandemic, is pretty darn close to the pandemic lows. So it's not a surprise that you saw a bid from the end of September into October, but a lot of it still hinges on inflation. One part of the reason why the markets have traded down today, I don't necessarily think it's a result of the election outcome, because I think the market priced in exactly what it was looking for. A lot of it has to do with CPI data release. So there's that macro concern that again is feeding into valuations. But if we cut apart the S&P 500 into growth and value and look at earnings over the next year, so currently the S&P is trading at 16 times forward earnings, which is well above its 5-year average and even 10-year average, which is about 18.5 and 17. If we bifurcate that into value and growth, there are a lot of slivers of value and cheapness in the market. If we look at S&P growth companies, they're trading at around 18 times forward earnings. If you look at value companies, they're trading a little bit above 14x. So if inflation does get under control, and price earnings multiples are a function of inflation, you would expect lower PE multiples with higher inflationary pressure. If inflation does get under control, and maybe at some point the Fed doesn't necessarily have to pivot, maybe they just posture toward a pause, and hopefully giving companies the ability to accelerate their earnings in quarters ahead, the value that you're getting right now could very well translate into a nice trajectory of growth in the quarters ahead. On the fixed income front, this again has been one of the most difficult periods of transition for bond investors, given the speed that the Fed has ratcheted rates up. Just again, we started out, if you look at the 2-year Treasury yield about a year ago, we were at 0.4%. Now we're well above 4% on a 2-year Treasury bond. But the takeaway here, if you look at this chart, this is looking at yields to worst, or starting yields. And this gives you the range over the last 10 years. The axis to the left is really giving you more of the investment grade, higher quality segments of the bond market. To the right, it's the lower quality segments, your high yields, your emerging markets debt, which we don't have any exposure to. But looking at the higher quality segments, U.S. Treasuries, now the municipals yield is adjusted for the taxable equivalent yield, if you're assuming you're in the highest bracket. Investment grades, mortgage-backed securities are all at the top end of the spectrum. And this is telling you that investors in the bond market are being paid to wait. Bond sectors aside, if you look at the aggregate bond market yield at this point, we're yielding about 4.3% as a current yield. I mean, that's a yield level that, you know, not only over a 10-year period, we haven't seen yield on the aggregate bond market like that for probably somewhere near 15 years. And it's evidenced by CD rates, it's evidenced by, you know, various components of the bond market. When we look at, you know, our investors' bond portfolio, we're north of 5%. So the interesting dynamic that you're seeing in the bond market when it comes to shorter-term maturities and longer-term maturities is the bond market has still been discounting higher inflationary pressure and therefore higher yields at the shorter end of the curve. So paper that's between 6 months to 2 years has actually been priced at a higher yield than your 3 and 5 and even your 10-year paper. So if we take the U.S. Treasury, for example, you know, if you were to buy a 6-month Treasury bond, it's yielding 4.5, but you go out 10 years, it's yielding a little above 4. I mean, the top was, I think, close to 4.3 before the last Fed rate hike. And what that's really telling you is the bond market is discounting that inflation at some point, at least over the next 3 to 5 years, is going to become more under control. And I think this is where it really behooves bond investors to, you know, really consider the merits of, you know, making sure that their interest rate sensitivity, the maturities that they have, are more so in line with their longer-term goals. So although we have, you know, taken measures to be more on the shorter end of maturities for this year, now you have longer-term yields that look very compelling, because if the Federal Reserve does in fact pause or pivot, if we do go into a recession, those longer-term yields are actually going to look very, very attractive to fixed income holders. So I think the big takeaway here is investors in the bond market are finally being paid to wait, and it certainly compels them to do so. I did want to talk about this earlier when we were talking about recessionary pressures and things to be mindful of. And the relationship here looks at you know, a whole subset of recessionary periods when the S&P's total return was at a trough, and then the rise in the unemployment rate, and also coincides with where a market low is. I know this could seem pretty busy. The big takeaway here is that, and this is something that I think investors need to be very mindful of, because in the months ahead, as inflation does start, or as the unemployment rate does start to go higher, you're going to see a lot of negative headlines, and that inevitably is going to evoke more fear into the investor psyche. But it is important to recognize, again, those metrics and most of the data that's being reported, most notably the unemployment rate, is lagging. And the relationship that you've normally seen is that the equity market, usually in tandem or in lockstep, rises along with the unemployment rate. You saw it in 2009, into 10 and 11. You saw it in various periods. Now, what I thought was really interesting is that if you look at the current inflationary environment we're in, many economists are likening it to the Volcker era, right, where Paul Volcker in 80 to 83 was hell-bent on controlling inflation at all costs, ratcheting up inflation, causing the unemployment rate to go much higher. So if you look at that 1980 run, I'm going to call that a micro-recession, and even the July 81, the center chart, to November of 82, what you'll notice is, and again, We're not saying that the past is necessarily going to be a proxy for the future, but the interesting comparison is that the equity markets actually troughed prior to the equity market low. And then, of course, when the unemployment rate started to go up with the Fed Chair Volcker raising rates at that point, you then saw the recovery ensue. Actually, I would say probably the better comparison is that July 81 to November 82, if we were to maybe try to run a regression model with today's Fed, in that, again, 14 months prior to the actual low in the market, the S&P 500 bottomed. It kind of revisited in that July of 82 era, and then, of course, you started to see the equity markets go higher after that double bottom. But again, the overarching trend here is the unemployment rate went up. So it's important to understand the equity market is a leading indicator, and we very likely may have already discounted the recession, those two negative GDP prints that we had this year. We won't know until the official recessionary callers, the NBER, tells us that. So again, I think this is, at least offers, a glimmer of optimism from a very rough period going forward.
And Paul, I get the pleasure to speak about the midterm elections.
That's better you than me, Roy.
Yeah, when we look at the midterms, we didn't expect, we planned this, to be after the election. We did expect that possibly we wouldn't know the outcome as of today of the election. But this chart really is not talking about if you're Democrat or Republican. This is really talking about facts of what happens after a midterm election. Historically, when we look at this chart, 6 months after the midterm election, the market, the S&P price performance, doesn't include dividends, is up 15%. In non-midterm periods, it's up 4.2. Now we go out 12 months, we're looking at a 16.3% return and a non-midterm average of 6.4. And someone's going to say, okay, what happens if by chance the Democrats retain the House and the Senate? A party did that 1 year and the markets were up still 20%, 12 months later. So it's not really political. For some reason, after the first midterm elections, the markets actually historically have done well. As Paul said, there you have leading and lagging indicators. A lot of the indicators that the public watches are lagging indicators versus, as Paul said, the price of the markets is really the leading indicator. I remember 2003. We went through a very tough period, and 9/11 and corporate corruption in 2002 and 2003. Everybody was expecting Armageddon, and the market took off and didn't look back. So this slide, the importance of this is just to stay patient, and we know it's been very, very challenging. We understand that. As you are concerned, we are concerned, but again, we're focused on, as we go forward, how to position a portfolio in both stocks and bonds and looking out for your best interest. So some real good news that inflation has caused. If we look at the tax brackets, what has happened here, the government has increased, because inflation, the brackets, to stay in the 10, the 12, the 22% bracket. So if you're a married couple, you can stay in the 22% bracket up to $190,000 of income. Why is that important? Because maybe, depending upon your situation, you may want to look at Roth conversions, especially if you're in a 12% bracket, which now is up to $90,000 of income. And don't forget, your standard deduction has also increased significantly because of inflation. As will, if you're on Social Security, your Social Security will have over an 8% increase. So it's, I like ending on some positive news, and this is actually positive in terms of the brackets going up and Social Security going up, and Medicare is not going up as nearly as significantly. In fact, I think they reduced rates moderately, very moderately. So with that, I want to turn it over to Mike and say thank you to everybody.
So thank you everyone for joining us for our webcast this afternoon. Again, if you have any questions, please feel free to email us at pwm@prestigewmg.com, and we'd be happy to answer them for you. Thank you so much for joining us.